Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moments podcast. My name is Jeb Graham, here with Eric Wymore and Ethan Hutchison. And how you guys doing today?
Doing good. Little upset I didn't get the Metcalf Partners swag memo this morning.
There you go. That's right. I actually wore this morning thinking I was going to be unique, and then I see Eric in here with the same thing on.
I know.
But you know
Exactly.
what? Hey, it's good rep. And
Well,
I
yeah,
was
exactly.
actually, because we got these new ones, the
know.
ones that are like, more tan, which I really love. But I remember when we first started talking to produce your podcast, they told me to wear dark stuff. So anyway.
Exactly. It's a little too chilly to take it off right now. So
It is. I know. We're kind of getting to this point in the middle of October where it finally feels like fall. We've had a lot of heat. But hey, so today, guys, this is going to be a good conversation. We got the an email from LPL, which was in their market commentary. I think it was yesterday or the day before, that we are officially at the 3-year mark of this most current bull market, which to me is crazy surprising. For whatever reason, it feels like, when we had that big pullback in 2022, that feels like that was 6 months ago, not 3 years ago to me, for whatever reason. And I think today is a really good time just to kind of hone in on bull markets versus bear markets, how long they last, this current bull market, and then also talk a little bit about, what we would consider investor psychology and ways to, maybe some things to avoid, whether you're in a bear or a bull market. So I'm going to take you through kind of bears and bull markets. Ethan's going to talk about this current bull market that's now officially 3 years old. And then Eric's going to talk, a little bit about some do's and don'ts and things that you can think about with bull markets. But let's talk a little bit about what is a bull market and what is a bear market. So when you talk about a bull market, that is when the market rises. And by the way, I guess I do want to disclose this. When we talk about the market right now, we're talking about the S&P 500. Now, there can be other indexes, like the NASDAQ can be in bull and bear, while the S&P might be in a different cycle as well. So bulls and bears are really specific to the investment grouping that you're talking about. Okay, so right now, we're for all intents and purposes, we're going to talk about the S&P 500 here today. Okay, but a bull market is when the S&P 500 or whatever index you're looking at is up 20% off of its most recent low. Okay, so if we're going to put that into the context of right now, if you think about the market low in 2022 was in October. Okay, and then basically the market went up 20% from there, and now we've been in a bull market since that time. Okay. And now, if you look at the bear market is when the market is down 20% off of its most recent high. So if we're going to take that into context, let's look at the end of 2021, where we had a market peak. Market kind of crashed in the beginning of 2022, went down over 20%, and that's when that bear market began. So there's a very big distinction between a bull market and a bear market, as well as a correction and a bear market. Okay, so when you look at a correction, that's when the market has gone down 10% or more off of its most recent high. So corrections happen a lot, right? So I think, what is it? We probably average about a correction a year, would you say? I mean, I don't have the statistics in front of me on that, but you get a lot of corrections. When you come to bears and bulls, you don't get quite as many. I mean, so let's talk a little bit about the differences in bears and bull markets as far as duration, effects, and all that stuff. And there's a couple of different data points that you can look at out there, depending upon what time period you're looking at. But for now, I'm going to, and we're going to show you a PDF here of a presentation that we have from First Trust, but I'm going to use a source of First Trust. Okay. And basically in theirs, on the time period that they were looking at, which is from 1942 to 2024, the average bear market has lasted about 4.3 years. I'm sorry, the average bull market has lasted about 4.3 years. And on average, the stock market, or the S&P 500, has gone up 150% during that 4.3 years. Okay. So huge increases over a 4.3 year period. And when you look at the average bear market lasts about 1.5 years. So less than a third as long as the bull market, or about a third as long as the bull market. And on average, the market goes down about 35% during those bear markets. Okay. So I guess something just to think about there is that just based on those statistics and what I just said, is that the stock market goes up a lot more than it goes down. It goes up about 75% of the time, right? So that's why when people always talk about market timing and they talk about just keeping your mind focused on the long term, to me, that's why, is that if you've got the market going up 75% of the time, we know the average bull market lasts 4.3 years or even longer, according to some other statistics when you look at different time periods. You want to stay in the market. And then when you actually want to look at those bear markets, not as something to run away from, but as something to lean into and as an opportunity. And I think that's kind of one of the things that we want to focus on. But if we're going to go back in history, we're going to talk about the longest bull market that we ever saw. And I was alive for the whole thing, but I was pretty young when it started. You know, when you're talking about the longest bull market ever was 1987 to 2000. So that's a 13-year period. I guess in 1987, I would have been 10 years old. 2000, I was just getting ready to graduate college. That was when the tech bubble burst. But during that time, from 1987 to 2000, we had a 582% gain in the S&P 500, according to Hartford Funds. And then the shortest bull markets can have lasted as short a time period as 25 days. And by the way, you know, there's always a little bit of debate as to whether we were actually in a bull or a bear at certain time periods as well, based on, you know, how long it actually breaks that barrier. But another context for this last bull market in 2022, I don't know about you guys, but I felt like that lasted like forever. It was like, felt like it was going on and on and on. The reality is it only lasted for 9.2 months. Okay. And the bear market before that was COVID. COVID lasted 1.1 month. Okay, that bear market. And if you looked at before COVID, we had an 11-year bull run where the market went up about 400%. So anyway, it's a case for playing the long game, staying invested, and then using those bear markets. Number one, being able to identify them, and number two, being able to take advantage of them. And there's that kind of old adage, and I believe this, and we've experienced it so many times, is that the stock market takes the escalator up and the elevator down, right? It's like it just kind of slowly goes up, and all of a sudden you wake up one day and the market's gone up 300% over 8 years or whatever it is. And then the next thing you know, it'll go down 30% in a 45-day window. And and identifying those and not being fearful, but leaning into those and using them as an opportunity, I think is a huge deal. So, but that's kind of a good, just kind of overview of bulls and bears. And I know, Ethan, we talked about this current bull market. There's some specific things and what's going on. And let's talk a little bit about the context around that.
Yeah. And I think the overarching theme that we want to hit on today is this is in no shape or form a prediction on what's about to happen, because history is going to repeat itself. We know what's going to happen, whether it's in the next month, whether it's in the next year, or whether it's in the next 5 years. We could have another 13-year bull market, which would be pretty interesting. But starting back in October of 2022, that's when we went from the all-time highs in December of 21, and then we experienced the low in October of 2022. And since then, the S&P 500 is up about 90%. We've had some hiccups along the way. Earlier in April of this year, when the tariff conversation occurred, we did have a big correction at that point in time that we kind of got out of, and now we're back at all-time highs again. So looking over the course of history, where we're at today, we're in year 3 of a bull run. If history repeats itself, we've got another good 12 to 24 months of this bull run before a bear market could potentially occur. So what do we do right now that stocks are at all-time highs, and we're still kind of dead in the middle of a bull market? We don't do much. We continue on that long-term path that we have. We don't look at the day-to-day volatility of the stock market or our accounts. We know that, over the next 13 years, if we got a 13-year bull run, we're going to stay in the market. And if we've got a bear market that occurs, over the next 6 months, we're going to probably stay into that as well. And Jeb made a good point. It's very contrarian to do this, but leaning into those bear markets. We get calls and we have conversations quite often when we're in those bear markets, like, hey, do we pull our money out? Do we sit in cash? Do we wait on the sidelines? What does that look like? And if you can take that psychological, mishap that you're having right there and put money into the stock market when it's at those lows back in October of 2022, if you invested $1, it'd be up 90% today. So having that lens on to just look ahead and focus on the next 15 to 20 years and not the next 3 years is really going to help you as an investor kind of come out of that bear market that we could potentially be experiencing. Possible trajectories. Where do we go from here? Kind of what's in our way. So we're at all-time highs right now, which is awesome. It's fun to experience all-time highs when you look at, I talked to my dad last week and he goes, we never thought the Dow would be over 10,000 or whatever it is. And we're well above that at this point in time. So what are headwinds that could potentially be there? Well, we've got tariffs, we've got interest rates, we've got geopolitical concerns and conversations that are occurring, every single day. We've got inflation that's still kind of around there and unemployment. All these bullet points that are out there that the talking heads on the TV are going to kind of, not fearmonger us, but just talk to us about. And we want to stress, all these things could happen tomorrow. All these things could happen in 5 years. And what we do know is that over the course of time, historically, and over the next 20 or 30 years, stocks and investing is going to be how you grow that money. So keeping that in mind when we enter these bear markets is a key component in being a well-educated investor.
Absolutely. Yeah, and I think, as we've talked a little bit so far about, a bull market and a bear market and how long they last and kind of where we're at maybe right now, a couple of the things that actually probably are a bigger threat than whether or not we're peaking out in the market and getting set up for a decline is honestly our emotions. I mean, they are a bigger threat than to our portfolio performance or our long-term financial plan than any kind of market volatility. We just talked about it. We know that, hey, a bear market's going to last for a little while, but we know what's at the end. The end is, compounding growth. And if we can keep our emotions in check, and one of the biggest emotions that we see a lot is fear, right? Fear sells. Okay. So when you're out there and you're reading these articles, they're not going to let you know of really good news. It's going to be the fear that sells. And I think, that causes investors to make that emotional decision. They start selling low. They're going to miss the recovery when that ultimately does happen. They're going to miss that time when they want to invest back in the market when it feels right. Well, oftentimes that might be 70, 80, 90% away from the bottom. But a fear is a big emotional feeling that you need to try to avoid. Another one is greed. There's an old adage that says, pigs get fat, hogs get slaughtered, right? We do want our good growth investments to continue to grow. But oftentimes, eventually, it's not a wrong thing to take some gains along the way and rebalance and making sure that we do harvest some of those gains. Nobody ever goes broke taking a gain, right? That's something that you want to make sure.
By the way, pigs get fat. What is it?
Pigs get fat, hogs get slaughtered.
That's right. I had an old boss who used to always say, "This guy thought he cut a fat hog." I was like, like that saying. It's good stuff.
Right. And, just greed leads you to overexposure in risky areas for sure.
Yep.
Another one is overconfidence, believing that you can outsmart the market, making those concentrated bets like this is a can't miss. If you learn anything from us, if you go into some place where someone is overconfident, find that exit as quickly as you can, because nobody can figure out, nobody has their finger on the pulse of the market.
Yep. I'll tell you too, we've experienced that. I mean, and this isn't something that's only particular to clients, right? Any advisor susceptible to this, right? Because there's certain times when you feel like, and a good example of that, and sorry to change the kind of subject matter, but I think a great example of that would be even 2022 into 2023, when everybody in the world, because interest rates had just gone up, right? Bonds went crashing down. And then the economy was supposed to start slowing, which never happened. So everybody was very convinced that the stock market was going to take a big fall and that bonds were just going to have this amazing time period. And neither one of those actually transpired during that time. Like bonds paid good interest rates and stuff like that. But the reality is a lot of people were overconfident in the macro piece of the economy. So they were underweighting stocks, overweighting bonds. And there was even a time period when we were a little bit guilty of that, if you guys remember. And I think there's lessons learned. And back to like what we were talking about earlier is if the stock market goes up 75% of the time, why are we going to spend our time trying to figure out when the 25 is and getting out of the 75, right? Let's just use that 25 as the opportunity and the something to lean into. And I think that's a good theme for today too. So
Absolutely. I mean, we are guilty of every one of these emotions, right? At some point in your career, you're going to, and
yeah,
that's exactly what this next one is just regret, right? You are going, anything you do in life, you're going to make a mistake, right? It's going to happen. And if you sit there and you just dwell on those opportunities that you missed or those mistakes that you made, all that's going to lead you to do is just kind of have this revenge or tilt or put, full pressure on to try to recoup whatever you lost. Sometimes you just have to step back, realize what happened, reassess what you're going to do when this opportunity or when this situation rises again, and just try not to make the same mistake. That's it. You can't sit there and dwell on it. Otherwise, you're going to miss out on so many good things in your future. Um, I got a couple more. One of them is the herd mentality as far as an emotion that could really cause a threat to your portfolio. This again is just kind of following what everybody else is doing, piling into those popular type investments while they're trending or because they're trending. I kind of think of this as kind of like the meme stocks back in 2020, 2021, where, everybody was piling into, like an AMC or a GameStop situation where, yeah, it had crazy returns. Don't know why. But that herd mentality is like, I want to be invested in that kind of the FOMO
mm-hmm.
style investing as well, where you're just don't want to miss out. Everybody's doing it. It's
Yep.
popular. Um, Usually by the time they become popular, they're kind of already had their, the
Yep.
majority of their performance.
We saw a lot of that at the end of
Yeah.
2021, not like meme stocks, and then even just like tech stocks that did so well during COVID because of COVID.
Yeah.
Like your Zooms and things like that, and by the way, those companies still benefited from, they still, like, I would say that Zoom and is still hugely benefited from COVID, right? But the valuation that it was at that point in time was not justified, even though, it's done what it's done. But I think back to your herd mentality, we've seen that so many times over our careers where people kind of follow the herd, and then it feels like it's never going to end, right? Like when you're in that time period where the market's gone up 40% in a very short time period, and it just feels in that time like this is different, this is never going to end, and when it does, it's the party crashes pretty quickly. So
Sure does. It sure does. Yeah, you always want to be one of the first to leave the party, not the
that's
Yeah.
right.
Yeah.
That's right.
Yeah.
leave it when it's on the high.
Party
But
hard early and get the heck out of there. That's
That's
it.
right. Yeah. Curfew.
Yep.
Yeah.
And in this last one, and you mentioned, where the stock market takes the escalator up and the elevator down. I mean, being on the escalator requires patience, right? An emotional decision that can threaten your portfolio is if you become impatient. If you're constantly checking performance, if you're constantly changing strategies or abandoning some of these long-term plans, you're creating this impatience that is going to be a bigger threat to your portfolio return than any kind of market volatility ever will be. It's I like the adage is, Rome wasn't built in a day; it was built every day. And that's kind of like with your investments and with your financial plan. You're not going to go from zero to retire overnight unless you hit a lottery ticket, right? Or something else. But at the same time, you're just building it every single day, and you have to remain patient. Figure out your plan, work with a financial advisor, work with a financial planner, figure out what your plan is, and then just stick to it. Review it, but stick to it. Don't jump to the next thing. Don't worry about what the herd is doing. Don't get greedy and have that hog get slaughtered. Don't be overconfident. If you make a mistake, it's okay. Learn from it. try to correct it and move on, and just be patient. And you'll have much, much better chance of succeeding in your financial plan than you ever will listening to some of the financial reports and the newscasts. So
That's right. That's right. You got to get it. Sometimes you just got to get out of your own way. And by the way, and that applies to us
yeah,
too, right? Sometimes we got to get out
totally,
of our own way. And I will
totally.
say, and we love the fact, as a group that we're 3 years into a bull market. Our lives are much easier during those bull markets, right? Things that the waters are a little bit more calm. But I was actually talking to another guy in the business who's been kind of a mentor over the years. And he always says that as a financial advisor, we like in a 5-year period, we earn 80% of our money in about a 12-month period, right? And because that it's when the stock market's volatile and people are thinking about making poor decisions, that where our value really comes in, even though there's a lot of other value that we add as advisors when it comes to just simply the investment management piece of it. There's those short time periods of turmoil. And I do like the fact that, and Ethan, you mentioned this, is that we're 3 years into this bull market. At the average bull market, and it depends on which data you're looking at, it's closer to like 5 years, right? The average bull market's closer to 5 years. So the reality is we could very much just be in the very midstream of this bull market. But you also got to look at the outliers. We've had, like we just talked about, 2010 through 2000, whatever it was, 2021, we had an 11-year bull market, and we had a 13-year bull market back in the late 90s. So that's why it's too hard to predict when the bear markets are going to happen. It's just so important to just keep that long-term thought process in place. So, but guys, this has been a good podcast, and hopefully some of our clients are going to get some good stuff out of it. So,
Absolutely. Yeah, one of my favorites. It's a good one.
yeah, it's a good topic to, honestly, we could do this podcast probably once a quarter because the message never goes away, right? It's one of those things that has to be continually repeated and talked about, even for ourselves. So anyway, this is Metcalf Money Moment Podcast. We are signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.